Hey, Paul, hang on a second.
Sorry, I was getting some. My virus didn't like me starting. My virus blocker didn't like me starting
Yeah,
the webinar. Gave me
no,
a
that's
big
fine.
pop.
And GoToWebinar is telling me that we have a not enough space to record it. So I need to get in here and
Move
kill
something.
one or the other of these.
Okay.
Hey, Mom, I know that we can't still hear you, but I know you can hear us. So hang on just a minute, and we're gonna create enough space to record this before we fire it up. All right, Paul. I think I'm struggling with it. I think what we ought to do is just go ahead and let it rip, and we can record it later for recording purposes. But for now, I think we can go ahead and let it roll because whatever it is I need to figure out, I'm not figuring out in the next 5 minutes.
Okay.
I'm going to go ahead and unmute Mom. Mom, can you hear me all right? Mom, do
Sean?
you hear me all right? Yep, I hear you
Yes.
now.
Am I the only one who's signed up?
You're not the only one signed up, but you're the only one here, and we're not going to keep you waiting any longer.
Okay.
Um, and since you're the only one here, I'm just going to unmute you, and whenever you got questions, let her rip.
Okay. I was going to say if you want to reschedule this so that you don't have to record it more than once.
It's not long enough that we need to worry about that kind of thing. It's like
Okay.
30 minutes from the time we start talking to the time we stop.
Okay. It's entirely up to you, but I'm willing to wait.
Yeah, no, this is more about building and reinforcing good habits for us than it is anything else. And so one of those good habits is starting reasonably close to on time.
Okay.
Paul, you're on, man. Let her rip.
All right, without further ado, I am Paul Allen. Sean Gillespie is also here. We are the managing partners for Redeployment Wealth Strategy. That is a registered investment advisory in the Commonwealth of Virginia. I am an enrolled agent. I prepare hundreds of tax returns annually, and that's why I end up giving all the tax presentations that we do. Taxes are complex. The software to enable you to self-prepare your own returns has gotten pretty good, and most people can successfully use it to file a correct tax return each year. However, every year I have people bring me something. Often it is a letter from the IRS stating that there is some type of problem with their tax return, something that they've filed themselves. And so this presentation is just a compilation of the most common errors that I see people make. There's some general guidance on how to avoid those errors, and not enough to make you a tax expert, but it's this year. Presentation should take about 30 minutes. I will strive to be timely, and I will take questions at the end. Tax questions are often simple. People will frequently say to me, Paul, do you have time for a quick tax question? And I will answer, it depends. Do you have time for a long tax answer? Because that's how that normally works. So we're going to save plenty of time at the end of this to answer those questions. So without further ado, talk about the agenda. I've got to go over some disclaimers and then talk about our transparency policy. We'll get into the actual errors that I see. I'm going to address a little bit of a special offer we have for you at the end, and then I'll take questions. Excuse me. First, the disclaimers. There are 4. Here's the first. Redeployment Wealth Strategies is licensed by the Commonwealth of Virginia to provide financial advice. So the business Redeployment Wealth Strategies is a registered investment advisory. It is registered in the state of Virginia. Registration in Virginia does not constitute an endorsement of our business or ourselves by Virginia. I am licensed by the IRS to provide tax advice and taxpayer representation, including at appeals, but this does not constitute an endorsement of me or my skills by the Department of the Treasury. And while I am licensed to provide tax advice, this presentation is not tax advice. This presentation is for information purposes only. Everyone's unique facts and circumstances will influence their tax or the tax advice that they would get. So I can't personalize this for anybody or everybody. So if you have a tax issue, you should seek professional assistance and address your unique facts and circumstances with them before you act on any information presented here today. And finally, Redeployment Wealth Strategies uses PIM tax services for clients who elect to have us prepare their taxes. Well, this is my favorite disclaimer because Redeployment Wealth Strategies and PIM tax services are the same people. It's still me and Sean. So the fact that Redeployment Wealth Strategies is registered in Virginia and PIM Tax Services is not a regulated business by Virginia means that I have to let you know that Redeployment Wealth Strategy clients are not required to use PIM Tax Services for their tax preparation in order to engage Redeployment Wealth Strategies for financial planning services or advice. That is a long mouthful. I hope you stayed awake. All right, transparency. It's kind of our thing. It's a cornerstone of our business. When Sean and I first got together and talked about how we were going to operate, one of our guiding principles is transparency. So in that vein, I present to you the following. Redeployment Wealth Strategies is hosting this webinar to call attention to our services. You are being marketed to. I don't think that's any surprise. We are providing information to you in the hopes that at some point you'll go, wow, those guys are providing great information. I would like to work with them more in the future. However, you are under no obligation to work with us in the future. You don't have to buy anything from us. You don't even have to provide us any additional information. If all you want to do is enjoy the free information available in this webinar, that is fine. And at the end of this webinar, I will announce a special offer for anyone who makes it to the end. So that would be that's your incentive to make it to the end, I guess. All right, without further ado, we're going to jump into the common tax errors. And this is the point where, because we are on the internet, I have to put in a fun cat meme. And then that introduces us to our very first common tax error that I see. And I didn't know any better way to call it except mangling your state return. So I see this frequently. I see a variety of errors, the way people get their state tax return wrong. And I think I see that because PIM Tax Services caters to military families, and frequently they will have a different filing status between their federal return and the state return. So they'll be married and filing jointly on their federal return, but because he's from Virginia and she's from Florida, they will have a different status for that Virginia return. And the tax software doesn't like it, because the tax software that you get commercially, you prepare your own tax returns, is designed to produce the federal return. And so when you tell it, hey, I want to file with a different status on my state return than my federal return, the software, which has advertised itself as being easy to use, maybe even fun to use, is no longer easy or fun to use. It starts arguing with you. And what people generally do at that point is they start putting in anything they can to try and get the software to stop telling them that they're making a mistake. And they'll get the software to produce a state return and file a state return, but just because the software allows you to answer a certain way does not mean that's the correct way to do it. There's no easy fix for this because there's such a variety of errors here. Each state is different. The rules for how you file in states are different. It's complex and confusing. The best hope you have really is to go to the state in question. All of the states that have an income tax have a website with rules and instructions on them. Some are better than others, but they all have them. And look up the correct way to get your tax return filed in that state and make sure that your software is getting you to that end. Right? I wish I had a quick and easy answer for you, but I don't. All right, next. Misunderstanding the MSRA. The MSRA is the Military Spouse Residency Relief Act. And here's essentially what the act says. The act says that the spouse of a military member, when they file their state tax return, can be a resident of the state you're serving in, or you can be a resident of the same state as the military member. Those are the two choices. So we're here in Virginia, and what I'll frequently see is that a military couple will come in and they will say, well, he's in the military and he's filing from Florida and I'm from Wisconsin. And even though I'm living and working here in Virginia, I'm going to file a state tax return in Wisconsin. No, you're not. That is not how the Military Spouse Residency Relief Act works. You can be, if you're living and working in Virginia because your military spouse is here on military orders, then you can file a tax return in Virginia, or you can file a tax return in the same state as the military person. Those are the two choices. All right. Now, previously, the spouse had to have established residency in the same state as the service member. That appears to no longer be the case. New legislation was just implemented last month that says, we interpret what it says as being that it's no longer required for the service member, or excuse me, the spouse to establish residency in the same state as the service member. They can just claim that now without having to establish residency there. So it made it easier for the military families to file from the same state. we believe. We're going to still, the law was, in my opinion, poorly worded, and we're going to wait to see how the states are interpreting that. But the way we're interpreting that as of now is that it got easier for military families to file the same state, which is good.
And by last month, we mean last week. It was signed 10 days ago. Yeah.
Yeah. Just at the end of, like, after Christmas, but before the new year. Anyway, and again, just because the software allows it does not mean it's correct. The software will be happy to allow you to file your Wisconsin state tax return. That does not mean that you should be filing a Wisconsin state tax return. And I don't know why I decided to pick on Wisconsin there, but because I see it for a variety of states. Anyway, moving on. Poor record keeping. Big mistake I see people make. And this is usually people who are starting up a sort of a side business. So if you're a landlord, you have a rental property, you're driving for Uber, you got Etsy, you're doing multi-level marketing business out of your home, whatever, or even a new business. It's keeping good records. Okay. And you don't have to keep them for me, although it can be helpful for me to prepare your tax return. And it'd be helpful for you to prepare your tax return as well. But the bottom line is that if the IRS wants to ask you questions about your tax return, they'll not believe anything you tell them if you don't have paperwork to back it up. Okay. So if the IRS says, hey, I have questions about why you took this business deduction, can you prove that you spent that money where you said you spent it and how you said you spent it? And if you can't prove that with a paper trail, a document trail, then the deduction gets disallowed on your tax return. You end up increasing your tax bill and then paying penalties and interest on top of that. All right, so then what I see is when I explain this to people who have kept bad records, is that they say, well, then I won't claim any deductions from my business. Well, now you're just not getting full value for your business. And as a business owners ourselves, Sean and I can tell you that managing the taxes on the business is part of being a successful business person. So if you are not going to take full value for your tax breaks as a business person, you're going to have a very difficult time succeeding in business. So I encourage you to keep good records. What does that entail? Just a couple of tips here. Keep copies of receipts, invoices, and statements, and don't just keep copies of them, but keep them sorted by the category of expenditure that it is. So have a filing system and keep good records and keep copies of things. Additionally, other documents you want to maintain are tax returns, information returns, and then anything that proves your income. It's less common that the IRS asks you to prove that what your income was or that you had income, but it is possible. It might also be necessary for you to prove that some things were not income. That's kind of a long story, but if the IRS says, we see $10,000 was put in your bank account, that must have been income from your business, and you have to prove that, no, that was a repayment of a loan I made to my cousin. Well, you better have documentation showing that that was not income from your business, but in fact, a loan repayment from your cousin. So you need to be able to prove your income or disprove money that went into your bank account was income as well. Digitize things. It's pretty simple to scan stuff. You can even just take pictures of it with your camera. I highly recommend this, especially with receipts, which are now all printed with these, they're called temperature or heat printers, and they fade after like 6 weeks or 6 months. Go look at an old receipt and see if you can still read it. You can't. So digitize stuff, scan it in, and keep it. The thumb rule is 6 years. Keep your records for 6 years. But if they're electronic, why would you ever get rid of them? Just keep them forever. They don't take up any room if they're electronic. So that's enough on record keeping. All right. Excuse me. Incorrect depreciation on a rental property. This is very common. In fact, I have had, of the dozens and dozens of self-prepared landlord returns I've reviewed, I have found 2 that were done correctly. It's hard. Depreciation is hard. It's a hard concept, so don't feel bad. I'm not going to explain it to you. It'd take me, we could do a whole webinar on depreciation sometime, but that's not going to be today. Instead, I'm just going to point out some of the errors that I see, and if you think you might have made some of these errors, one or more of these errors, then let's try and get it fixed. And here's what I typically see. Deciding not to take depreciation expense, that's a mistake. You actually are not allowed to not take the depreciation expense. There's a really long reason why, and I won't get into it here unless you have a question for me about it, but you need to take the depreciation expense. I see frequently people say, well, it was confusing and I didn't want to do it. So I just decided I wasn't going to take the expense. That's not allowed. Anyway, depreciating the land and the building. So for tax purposes, only your building depreciates. So when you calculate the depreciation expenditure, you have to separate the land value from the building value before you make that calculation. Frequently, people don't know to do that, and so they're over depreciating their property. Expensing improvements that should be depreciated. So say you replace the roof or the HVAC, those are things people will sometimes, I spent $10,000 on a roof. They write that off in the year that they spent that $10,000. That would seem to make sense, but that's not in accordance with the law. You actually have to capitalize and depreciate those certain types of expenditures using the mortgage amount for the depreciation amount. That's not the same thing. Depreciation is based on the value of the house, not the value of the mortgage on the house. And then some more complicated things, which is bonus depreciation or Section 179 depreciation being applied improperly. Those are ways to accelerate taking a depreciation expense, and sometimes people get a little overzealous with that on their self-prepared tax returns. And then not applying Virginia. This is for Virginia people, of course, only, but Virginia has what they call fixed date conformity, which is the fact that Virginia mostly conforms to federal law, but they do not with respect to bonus depreciation. And so people that take bonus depreciation on their federal return then don't adjust for it on their Virginia return. That's the mistake I'm pointing out here. That gets pretty complex. Like if you think you made one of these mistakes in calculating your depreciation, it can be fixed, but fixing it is actually even a little weirder than calculating depreciation in the first place. Because after 2 years, you're not allowed to fix depreciation errors by amending your tax return. Instead, you have to do what's known as at request to the IRS to change your accounting method, because changing in the way you're depreciating in a business asset, which is what a house is that you're renting, is the change in accounting method. So there's a form, it's called the 3115. It is 8 pages long. You can read the instruction book 10 times. You will still not understand how to fill it out. I would not recommend trying to do this on your own. Please give us a call here if you think you need to fix some past depreciation errors, and we can help you out. All right, moving on from depreciation. Mistake I see is people pay taxes on their child's income. So they include a child's income on their own tax return. Parents will. And typically what happens is grandma sets up a Uniform Gift to Minors Act or a Uniform Transfer to Minors Act account for little Susie. Little Susie gets a 1099 DIV form in the mail, but of course little Susie is a kid. She doesn't open her own mail. Mom opens it. She sees this tax form and says, well, I guess I have to include that on my taxes. She doesn't know what else to do with it. And so she includes it on her own tax return and pays the tax on it herself. Stop doing that. I see so many parents do this. It's interesting to me, but Susie is her own tax identity. Her income is not your income. And if it's, $175, Susie has no tax liability to the United States. So don't pay taxes on $175 or whatever that isn't required to be taxed. And if little Susie has thousands of dollars in investment income, then she gets to file her own tax return and pay really crazy tax rates now. But she doesn't pay your tax rates, she pays different tax rates now. It's part of the new tax law. But at any rate, her income does not go on your tax return. That's not the thing you want to do. So my parents who are out there doing that, stop doing that. All right. Next error I see is people delay responding to a tax notice they receive in the mail from the IRS or the state. All right. Tax authorities use mail to contact you. They do not text you. They don't email you. They don't call you on the phone. If that's how you're contacted, it's not the IRS. The IRS will send you mail, U.S. mail, and you will get it. And they'll tell you things like, hey, we've changed your tax return, which is probably something you want to know, or we're thinking about changing your tax return. Do you agree? Or we need additional information, or you're being audited, or you owe us money, or we've turned you over to collections because you owe us money and we can't find you, etc. All right. Almost all these notices require that you respond to them and the time allotted to respond is limited. It's usually 30 days. Sometimes it's 45 days or 60 days, but it's usually 30 days. These things do not age well. Okay, I tell people they don't age like fine wine. They age like fresh fruit. They get stinky in a hurry because delaying responding to them reduces your options, and it makes you look uncooperative to the IRS officer who's been assigned your case, and that further reduces your options because now that person's not going to be very helpful. So don't delay. All right, open them. If you don't understand them, get in touch with a tax professional who can help you out. And speaking of tax professionals, is my last mistake to address here, is that some people will pay someone they believe is a tax professional who is actually not a tax professional. And they usually find this out because they've been paying the same person that they knew through friends or met at church or something. And then they have a problem with their tax return and they call this person and that person no longer answers the phone. I've heard that many times, more than I care to relate here. But and the problem here is that the IRS is not empowered to regulate the tax preparation business. They've tried a couple times, and every time somebody takes them to court and the judge says there's nothing in the Constitution or the U.S. Code that says you can regulate the tax preparation business. IRS, mind your own business. So that's, there's some good parts to non-regulation, but the bad part is consumer protection. So businesses are being opened without training or qualification by the people opening them. All right. Something you need to keep in mind all the time is no matter who prepared that return, it's yours. The tax burden is yours. Doesn't matter who prepared it or signed it. It is your taxes. Okay. Now I'm going to put this on the bottom of the screen here. This is this came about 2 months ago to me. A gentleman came in here and said, Paul, I've been using the same tax professional for a number of years, and I got a letter from the IRS saying my 2015 tax return is being audited, and now she doesn't answer the phone anymore. And I said, can I see your 2015 tax return? And this is what it looks like at the bottom. No preparer signature, just says self-prepared. Well, guess who put self-prepared at the bottom of tax returns? TurboTax. So this person was using TurboTax and charging people money. They don't have a P-10, which is something the IRS was allowed to regulate, which is the issuance of P-10s. So in order to be a paid tax preparer, you're required to have a P-10 and you're required to sign the return. All right. So how do you find a professional? How do you know how to find a professional? And so I got a list here of things to look for. And the first is a credential. Here are three. There are others, but these are one of these three I would look for. AFSP just means annual filing seasoned preparer. It is the lowest sort of entry level credential. I think you have to have 6 or 8 hours of training, and then you can apply to the IRS. And it's more or less just a registration and showing some minimal effort about being serious as a tax preparer. Then there's enrolled agent. That's the credential I hold. That is the IRS controlled license to represent taxpayers before the IRS. And then CPA, which is a state controlled credential. So the Commonwealth of Virginia regulates CPAs in Virginia, but those are credentials to look for in a tax preparer. Additionally, make sure that your taxpayer has a preparer tax identification number. You can ask them what that is. It's a letter followed by 8 digits, and they should be able to provide that to you. You could ask for an EFIN. After I put this on the slide, I realized nobody's really going to tell you their EFIN, because if I told you what my EFIN is, people could file returns using my EFIN, and I don't want that. So that's kind of a number you keep to yourself, but you could ask if they have an EFIN. If they don't know, look like they don't know what you're talking about, they probably are not going to be able to electronically file your tax return for you. They're not an actual professional tax preparer. And then make sure they sign the return, or at least sign the 8879 that authorizes electronic filing of the return. And then things to look out for: red flags, a fee that is based on the amount of your refund. If somebody tells you, hey, my fee will be 20% of your refund, look out for that. That is a ruse by people who will manufacture a return with your name on it. It will not be based in reality. It will be based on maximizing your refund so that you can so that they can get the largest fee possible for that 20%. If someone prepares your tax return and you have not had a appreciable difference in your income level, and yet your refund is much different, much larger than in the past, that could be a red flag as well. If they say, I can't e-file returns, we'll have to paper file your return, that would be a red flag. And then if they're using commercially available software that you might also use, like TurboTax or TaxSlayer or any number of them, then that might also be a red flag, because professional tax preparers use professional tax software. It's not the same flavor of software that people use to self-prepare their returns. All right. I said there'd be a special offer at the end. So when Sean and I take on new clients, part of the fee structure is an onboarding fee. We call it onboarding fee of $300. So it's an upfront onboarding fee. And if you make an initial consultation appointment with us before July 9th, which is 6 months from today, we will waive that initial onboarding fee if you become our client. So the initial consultation, by the way, also free. So you are under no obligation. You could come in and have an initial consultation appointment with us. And if you do that by July 9th and you've mentioned that you've sat through this webinar, then we will waive the $300 onboarding fee for you. And also a good place to point out that our clients at Redeployment Wealth Strategies are eligible to receive deeply discounted tax preparation, planning, and representation services from PIM Tax Services. And sometimes if you're at the second tier of financial planning fees or higher, that discount is 100%. So they're just included with the price of financial planning. Okay, that is all I have. Well, let me say, taxes are a significant part of financial planning for most Americans. And I talk to people every year who wish they could get a do-over on something they've done tax-wise, or something they did not do that they wish they had done, and it's having a substantial impact on their taxes. If you have questions about anything I presented today or something else tax-related that you want to ask, I guess now's the time.
I have no questions. Thank you.
Okay. Well, then I think we are done here. And